Welcome to the STR Data Lab.
Hello, and welcome to the latest edition of the STR Data Lab. I'm Jamie Lane, Chief Economist at AirDNA, and I'm joined today with Taylor Marr, Senior Housing Economist at Airbnb. Taylor, thanks for joining the podcast.
Thank you for having me here, Jamie. It's great to be with you.
So there's a ton that I want to get into. And for this audience, I think maybe we can skip the rundown about what Airbnb does. But I'd love for you to share, just to begin with, some about your history and sort of your path and how you ended up at Airbnb.
Yeah, so a little bit about me. I come from Redfin, where I spent the better part of the last 8 years studying housing and the economy and how it relates to the real estate market as well as the long-term rental market. So I'm passionate about housing. I've studied cities and what they do to build more housing, zoning regulations. That's my bread and butter of my research. I focused a lot on, just the changing market during the pandemic, during afterwards, with the greater tightening with inflation, how that's really brought down the real estate market in recent years. And before that, before I was at Redfin, I studied economics in Berlin. So I've always had a passion for international economics and trends across countries and how they compare to one another. I ended up writing my research on the policy responses to the housing bubble. So that's really how I first got into housing, studying housing, what led to the housing bubble, and did those policy regulations, such as the Dodd-Frank Act in the US, did they actually address some of the underlying issues that were present, such as predatory lending, people having exuberance about how much real estate prices will grow and their means to afford that. So that's, still present in the real estate market today, still present as it relates to Airbnb, and really just housing all across the world. People are trying to figure out, policymakers in particular, trying to figure out what to do about housing, how to fix it. Many people complain about housing affordability challenges. So that's really what I've been researching for the past decade. So what led me to Airbnb from that journey is really just excited to take my research to the next level on a global scale, working with cities around the world and applying my housing expertise, digging into the data as I've been doing, and hoping to find some solutions for cities to grow and to help their housing markets function well.
Yeah, and maybe we could start with that because me as an economist, I came from the lodging space, from hotels, and sort of found my way to AirDNA, and you came from housing and found your way to Airbnb. And it's something that I didn't have the background when I sort of got into this sector on the housing side. And it's something I found really quickly that was sort of lacking in my education of short-term rentals is this unique sort of mix of traditional hospitality, like people are traveling and staying. But instead of commercial real estate, which is sort of purpose built for people traveling and staying in these units, and it's more single family homes, it's condos, it's townhomes, it's lofts, and sort of the economics of housing is just entirely different than sort of what I saw in the commercial real estate aspect. And you joined at a time too when there's a lot of debate going on about regulations, short-term rentals. You talked about how zoning and housing use had been a topic they'd really studied in the past. So, and I know you're only a month in at Airbnb, but do you have any initial thoughts on like how cities, housing groups should at least be thinking about short-term rentals in their communities?
Yeah, so just to take a step back and agree that housing is a complex issue, especially housing economics. I think there's a million armchair economists that like to talk about housing and prices are either rising too fast or not fast enough, or rents are declining. And my experience has been in talking to folks and working with the media or policymakers is that there's a lot of unappreciated aspects of housing economics that really are very unintuitive. And the different factors, both on the supply side and the demand side, that lead to a rapidly evolving housing market are just easy to overlook. So I'll give you one quick example that I think has been underappreciated is that the rental market, for example, had a surge of demand during the pandemic. And even in places where millions of people were leaving. So, New York City, San Francisco, people were leaving them in droves. And I studied migration quite a bit because I think it explains a lot of the variation across the country in terms
Mhm.
of their housing markets. So, as people left New York and San Francisco and other cities during the pandemic, people would have expected demand fell, and therefore you should see prices fall or rents fall by extension for the rental market. But we didn't. In fact, most of the places that even lost people saw continued growth in the rental market. And part of that was because household formation surged. So instead of having three people sharing an apartment downtown, they were Zooming, working remotely, and wanted more space. And so a lot of people started to decouple, form their own household, get an extra apartment. So instead of three, you might have two people renting two different apartments. And that led to more demand for the rental market, which really changed the whole analysis with households versus population didn't change, right? It's just demand for housing increased because people need more space. So that's one example as to how housing is complicated. There's all these moving pieces as it relates to, regulations and cities and what they should be doing. You know, first and foremost, it's that if prices are rising or rents are rising, it's because demand has outpaced supply. So that's fundamental. We can, pretty much agree with that. But I think there's all these components of demand that have increased, and that's what's more complex. And so if there's any challenges in housing markets, local or national, it's because cities aren't building enough housing to accommodate the growing demand. And it could, again, be that there aren't any changes in households or population. It could just be that we need more space now that we're working from home and we need to add to the housing stock in order to prevent, you know, housing from becoming unaffordable. So that's a key issue, that we want to highlight and kind of figure out what is that actual increase in supply that's needed.
Yeah, and it seems like there's the demand aspects, there's the supply aspects, and there's so many different pieces that were impacting demand over take the past 3 years, and then you think back the past decade, 2 decades that we've seen such wild swings. Like, it's a really complex, issue, and it takes pretty complex models and sort of research to really understand what's sort of driving overall home values in a market.
Exactly. Yeah. And then the challenge too is that a lot of these changes end up also having a feedback loop or a second order effect that ends up happening as well. So as household formation increased, for example, which pushed up rents, the feedback loop there is then developers need to build more apartments. And so they started to build a lot of apartments. The good news is that supply does respond, it's just slow. So we're building a record number of apartments in the country right now. More than a million are under construction right now, coming on the pipeline for people to rent out. And that is helping to cool off rents in the market. So the market does function well. The problem is in cities that limit how quickly the market can respond. So if cities have strict zoning regulations or a lot of things in place that limit the ability of developers to build more apartments, or single family houses as demand shifts towards that segment of the market, that's really the challenge. Is it just slows down the market to do what it needs to.
Yeah. So, and just hearing you talk, it seems like you just have such a deep understanding of the housing market. I was listening to another interview you'd done, and where you shared that you had lived in 15 different homes in 10 years. And it seems like before even joining Airbnb, you were already embodying the sort of live anywhere lifestyle. So maybe initial question before we dive into the housing market is, did living like a nomad for that long sort of have any impact on your interest to join this sector?
Absolutely. So you're right. I've lived in 15 different places now for the last 10 years since I've been married. I've been married 11 years. My wife and I have moved around quite a bit between Seattle, Chicago, DC, Germany, and a couple other places temporarily. During the pandemic, as millions of people did during the pandemic, working remotely and being able to move states. So I left Seattle and moved to the DC area during the pandemic. And during that time, I actually needed to sell a house in one location, hunt for a house in a new place. and figure out what neighborhood to live on. So Airbnb was actually pretty impactful to me because I was able to live out of an Airbnb for a couple months while house hunting, while closing on a home, and living in the actual neighborhoods that I wanted to be able to buy in to see what is it like there. When you're new to a new area, that's the biggest thing you don't know is what are the different neighborhoods like. In fact, that's one thing that holds back people from migrating more often is just unfamiliarity, the uncertainty of a new place. What are the neighborhoods like? How close is it to different jobs and things like that? So that's something I've always been passionate about. At Redfin, I did a lot of research on migration and why people aren't moving more often than they should and why mobility has been declining. And of course, we saw an uptick during the pandemic, but the flexible nature of housing really enables migration to pick up. So being able to rent a home on Airbnb for a month or 2 months as you make those transitions is really impactful. And that's something that I think all cities should allow people to do is really have a flexible segment of the market that enables this process to happen. The same thing can happen, while you're getting ready to sell the home, if you're not ready to sell it because of the economic environment. Having that flexibility is also an important to functioning well housing market. So I've lived out of Airbnbs for some time. I've actually hosted my own home on Airbnb while I've traveled, and that was a really positive experience. It really helped pay for some of the vacation, and it really helped me see also the challenges of setting up a home and what are the rules and how do you figure that out. And housing is just a really complex thing that touches every aspect of your life.
Yeah, and hearing you say that, it was a point that we talked a lot about, and I feel like it was not talked about enough. We had this great migration that happened in back half of 2020 into 2021 into early 2022. All the while, we had sort of record low availability for housing. So all these people wanted to move. They couldn't find housing in the new market they went to. And really, some of the only ways people were able to live in the market that they need to be able to put an offer on immediately the day of a sort of home came available was leveraging short-term rentals, leveraging Airbnb listings to be able to live and stay until they found more permanent housing.
Yeah, it definitely there was a lot of friction in the housing market when there's low vacancy, when there's low availability of listings for sale or for rent. And that can be really challenging for someone to navigate. Either their lease comes up and they need to move. They're hoping to be able to buy a home before that lease ends, but sometimes they need to have an in between space as well. And in fact, about 1 in 5 bookings on Airbnb are for long term stays. And so this is actually a pretty significant part of the market that has taken place since COVID, especially.
Yeah, I want to dig in a bit towards the end of the interview about that. But first, sort of given your history at Redfin and that unfortunately never had you on the podcast before you left, I was hoping maybe we could dig in a bit just about what's going on in the housing market, assuming you've still got some thoughts on where we've been and where we're going. But maybe you could just start with a quick housing market overview and where we're at and maybe how we got there and to the spot today.
The housing market has changed dramatically, up and down and up and down during the past 4 years. So it has been a wild ride. During the pandemic, the immediate shock of the pandemic was a lot of listings were removed from the market for sale. A lot of rentals were not available. People just froze in place. But a lot of people also, moved quickly after that. After the lockdowns ended, that's when the surge of moves started to take place. They were pent up and people started buying homes, moving to a new rental, moving in with family, and this great migration that started to happen during the pandemic. So we had a big increase in demand, but supply was sort of held back and slower to catch up during the pandemic. That inevitably resulted in quick price growth. And in fact, the Case-Shiller hit record number price appreciation during the pandemic years. And so really housing just started to experience quick affordability challenges. Now, at first, mortgage rates were hitting rock bottom. A lot of people were able to refinance, get a low mortgage payment. And so the immediate effect was you had a lot of winners who bought in late 2020, maybe early 2021, before prices rose so much that any gains from low mortgage payments were offset by how competitive the market was. The rental market was a little bit different. It was a little bit weaker, but still it was challenging because there just wasn't much available at the same time. So these two dynamics captured most of the pandemic period that people experienced in the housing market. Then fast forward to once the Fed started to hike rates to really tamp down inflation. Inflation was a universal experience across the country. I did some research that did find that inflation rates were much higher in the places that people were moving to. So places like Phoenix and Tampa had inflation rates that were more than double places like New York and San Francisco that people were leaving. And this inflation experience, across the country caused the Fed to have to hike rates at their fastest pace in more than 4 decades. As they tightened monetary policy, hiking their short-term interest rates, we also saw mortgage interest rates start to spike. So they were sitting around 3%, and then they slowly, or very quickly rather, climbed. They climbed at their fastest pace in more than 5 decades, quickly shot up. I think they're over 7.5% right now. So they continue to be very high. And really, that high mortgage interest rate is what increased mortgage payments to be massively unaffordable. People have had really big challenges being able to afford a home, and a lot of people have just been priced out of the market. There have been ways that they've navigated that, such as builders have offered to buy down rates and give people a temporary good deal on a mortgage rate. But that comes at a cost and a significant amount of risk that grows the longer rates remain high. So now we're at a housing market that is really hitting rock bottom in terms of sales. Prices remain extremely high compared to the monthly mortgage payment, which is high because of mortgage interest rates are being high. So the affordability challenges are very significant. How we come out of that is either mortgage rates fall, probably not going to happen very quickly. Prices crash, doesn't seem to be happening because people aren't forced to sell. They can just opt to not list their home and stay put. And that's primarily what's keeping prices high. So despite, the concerns of a price bubble, the reality is just that sellers hold the power, homeowners hold the power, and they don't have to sell. So that's keeping prices up. There are some markets where prices are down more than 10%, but those are really the exceptions, not the rule. The rental market, on the other hand, is finally getting some supply that's needed, and rents are starting to fall. So that is where the good news is rents are down a couple percent in some places. It was the most significant part of inflation in the latest report, that it continues to be what the Fed needs to control for the economy to improve. And so that's good news. It's coming. It's just slow. So that's basically the rundown on the housing market.
So we did see maybe a little bit of price weakness in the housing market at the beginning of the year. But broadly, are you surprised how well the housing market has held up in 2023?
I am a little surprised when I look at, could I even afford my own home that I bought? I bought this home during 2021 as I moved during the pandemic. And, I got a 3% rate. I could not afford this home today at today's mortgage rates. Even if I were to buy down the rate by 1 or 2 percentage points, that still leaves it at 5.5%. That's really big difference in a monthly mortgage payment. So I think the affordability challenges are so significant, even with some temporary, 2-to-1 buy downs is what they typically say. You buy down the rate by 2% for 1 year, 1% the next year, and then it levels out. And at which point most people are hoping they could just refinance. But they're so elevated right now that it's hard to envision prices not coming down a little bit more. We really need supply in order to make that mechanism happen. And supply is not really coming out very much, the for sale market. So I am a little surprised that it can just remain at a standstill this long. But that said, where we come from here is still a pretty big mystery. The Fed hopefully will start to be able to lower rates, and that should put some downward pressure on the mortgage market. But it's really a slow process. So we're not talking any immediate relief. And as long as people are okay to stay put for another year or two, then we'd probably have supply remain constrained for that long as well.
So it seems like your outlook for the maybe next 12, 18 months is maybe more of the same of what we've seen in sort of this supply constrained, elevated house price, forced sellers are buyers. Like there's no real change in the outlook, let's say.
About 6 months to a year ago, most people, most housing forecasts pretty much had a consensus that this was a temporary thing, that inflation would come down quickly, the Fed would end hiking rates quickly. But things have shifted really over the last 6 months or so, that inflation is here. It's higher for longer, which means the Fed has to keep rates higher for longer in order to bring anything down. And so that said, really the situation is just lasting much longer than anyone expected. And so that's the state of affairs today.
And thinking about the outlook too, sort of what does your sort of thought process around different economic scenarios, sort of how does that play into the view of like, and there's, I think, still consensus view that we go into a recession over the next 12 months. And that had been the consensus view last year as well. And so far we've sort of stayed out of recession. But I mean, if we go into recession, even if it's a mild one, versus if we see another year of sort of upside, 250,000 jobs being added per month, unemployment at still 3.5%. Like, what do you think the divergence in the different economic scenarios could mean for the housing market?
So, with the economic outlook, it is true that it seems like we're always on the cusp of a recession. I think there's that old adage that economists have predicted 12 of the last 9 recessions or something like that. And it is just that, there's so much uncertainty that it's increasingly likely that we could tip into a recession. But that matters less, whether or not we're in a recession or not. What is clear is that the labor market is cooling some. Layoffs and unemployment have risen, jobless claims, for example. And at the same time, GDP growth has slowed from the pandemic boom that we were in. So the economy is cooling off. Whether or not that crosses the line into a recession officially or not, I think matters a little bit less. But that economic weakness overall certainly will have an impact on the housing market. It's not going to be as vibrant, not going to be as strong if for the next several years because of that lackluster economic growth. And so that means a lot of things. It could mean less equity for homeowners to tap into. It could mean a challenging market for renters as well, not getting as much rent relief as they maybe hoped for. But, income growth seems to still be relatively strong. And so even if we can keep housing costs relatively stable, a little bit of income growth will actually matter for the typical renter more than anything.
Yeah. So in thinking about the outlook on two, and I know you're active on Twitter, as I am, and I'm sure you know these people well, sort of the housing bears out there occasionally sort of bring short-term rentals into the fold. And there's this sort of common refrain that there's going to be an increase in available listings from short-term rental hosts that's going to exacerbate some sort of housing downturn, or could be even the trigger that causes a housing downturn. Of all those things, now that you're sort of in and looking at the data, and do you think there's any validity to that at all?
Well, the theory is certainly valid that if you have a segment of the market and it's performing poorly and you expect that to really spray over or spill over into this other segment of the market, a wave of supply certainly could cause real estate values to fall down. The question is one of magnitude and what are the other factors at play? So, one of the most significant factors in the real estate market that I just mentioned was that people aren't listing their homes for sale and they're staying in place because mortgage interest rates are high. Well, it's not just because, it's unaffordable to buy a new home. It's also that they want to hold on to that 3% rate when rates are 7.5%. Once you give it up, you can't get it back. So that's the mortgage lock-in effect, that a lot of homeowners want to hold on to that low mortgage rate because it means they have a really low mortgage payment on their home. And so that factor is really important because the lock-in effect, where all of the millions of homeowners, the vast majority have a rate under 4%. And those millions of homeowners are going to be reluctant to sell, even whether or not they have a long-term tenant, they live in it themselves, or they have a short-term tenant. Or maybe they go back and forth between long-term, short-term, and keeping it for their own personal use. The market is much more fluid than I think we give it credit for. But they hold the power, and that lock-in effect is pretty significant for what might result in some supply being able to shift and them listing it for sale. So even if, the performance is lower and there's a bunch of supply, there's this other factor of the lock-in effect that might hold back some listings from actually spilling over. So that's one dynamic is, how do things move across from one or the other? There are a lot of other factors that play too, such as the tax code system really is generous to people who own real estate. And then there's the other factor of magnitude. So in a lot of these places, really the size of supply is just not significant enough to bring down the US real estate market. And the other factor is a lot of these are driven by anecdotes. So there might be one person who bought a home and can't afford it anymore, and therefore they're selling. And that happens every day, even during a growing real estate market. People buy a home, it's not the best situation for them, and so they choose to sell it. The question is, do we have a net increase in this enough to really warrant a significant shift in supply of that for sale real estate market? And in most places, the answer is no. The short-term rental market that has the potential to shift into the for sale market is just relatively small. It's on average less than 1% in most places. And even if they did have poor performance, why not just get a long-term tenant? They don't necessarily have to sell, which is the core thesis to a flood of supply for the for sale market. And then the other aspect there too that has to be considered is that even if, let's say, their performance has dropped by 10%, and that might be a common statistic that's cited, is they made, let's say, $2,000 in the short-term rental market this month, and now they're only making $1,800, and so that drop. Now, the reference point is not always what did they make at the peak or some month where there was some Super Bowl event or whatever, but it's also what is that in reference to their mortgage. And as I mentioned, mortgage rates hit record low, historic lows of 3%. A lot of people were able to get even 2.5% or less, and also build up a record amount of equity that a lot of people paid cash for rental properties during the pandemic because they were able to tap into all the equity that built up. Both of those factors means that, whether it's $2,000 or $1,800, their cost for properties is likely much lower. And even if something is less profitable, it doesn't automatically mean that that's going to be supply that hits the real estate market. And the final point I'll make on this is just that timing matters. So it's not like you flip a light switch and it all hits the market at once. It could take 2 years before properties shift from one segment of the market to the other. And the same is true when the real estate market right now is very unaffordable. No one wants to sell. They want to hold on to that rate. They might, when they move next, decide, I'm going to find a long-term tenant and put it on the for rent market. That's the natural mechanism that supply shifts from the for sale market, owner occupied, to the tenant occupied market. And that helps to cool down rents. And, that's just a normal mechanism, but it just happens over years. It's much more smooth and fluid than sort of a bolt of lightning that causes a crash.
Oh, Taylor, you don't know how excited I am to hear you say that. Very level-headed and well thought out response. I appreciate it. And one that I think I can't agree with disagree with a single point that you made there. So great to hear. As you've been sort of analyzing housing for a decade now, and that we've got a lot of sort of newer, sometimes sort of longer term investors that listen to the podcast. What are some of your favorite sort of metrics that you look at on a regular basis for tracking the health of the housing market?
Yeah, so it depends on the segment of the market, but overall in the real estate market, I like to look at sales. So when the quantity of sales is up and healthy, that tells me that buyers and sellers are active in the market, and there's a lot of transactions happening. So right now, I think some of the latest data puts sales volume around 4 million or just above that. Existing homes are transacting in the market, and that's pretty low. That's near rock bottom, especially given how many households there are in the US. That's a really low turnover rate of properties. So the turnover rate, how much are people selling properties, transacting, is one way to gauge the health of the overall market. Prices obviously are another one. When demand is growing, then you should see some level of price appreciation or rent growth. In the rental market, it's kind of the same idea. It's really just how many people are moving. So there's no real clear metric as to renter moves. They don't really track transactions in the same way, but the census does track mobility. How many people moved, either changed homes within the same county, across counties, across states, and that mobility for both the for sale market and the for rental market is, I think, one of the best ways to understand how healthy is housing in a given county or across the country.
Same question, but how do you expect that to change now that you're at Airbnb? I'm sure you've started to think about, like, what are the new things you wanna track? What are the metrics that might be most and relevant in your new role? So, have you given any thought to that yet?
Yeah, so some of the metrics that I'm most interested in still have to do with housing. So I'm a housing researcher. I like to just think about all of the homes across the country or really across the world, and what's their use, what's their function. So before I was studying exclusively the for sale or the for rent market, and a home usually just goes back and forth between them, or there's a little bit of overlap. But now, really, there's just another segment of the short term rental market that overlaps with all of them. Renters can rent out their home short term. Owners can rent out their primary residence short term. Investors can also rent out a vacant property on the short term rental market as well. And so I like to look at listings. Where is the supply and how fluid is it? So the listing growth is going to be a key thing that I track, and how is that impacted by regulations? So we know, and I know AirDNA has reported on some of this, that when there's a significant regulation in a city, you see a drop in listings for short-term rentals that can no longer operate. And one of the things that's going to be most interesting to me as I begin this research program at Airbnb is going to be what happens to those homes. Do they show up on the rental market? Do they get listed for sale? Do they go onto the black market of the short-term rentals? Do they just sit vacant? Before Airbnb, we had millions of vacant homes across the country that were just for occasional use, like a lake home or a beach home that you only occupy 1 month out of the year or 2 months. And so I'm going to be really interested in still housing and how it functions across those different markets, and the growth of those listings as well.
Yeah, that's something that I think that there's a not a lot of sort of visibility and comfort in, is what is that housing supply that's out there, the different use cases of that housing units, and then and just how many are sitting vacant, aren't tied to someone's sort of primary home use case, how few of those are actually in the short-term rental market, and how the use of those homes sort of changes over time. And it's been one of my theories for a long time, is that and short-term rentals and the growth that we see in this sector could not cause any decline in primary home usage, but just grow entirely from existing homes sitting vacant, and that in the end it would be in a much better use of that real estate if it's sitting vacant now, not generating any economic income, and the fact that people could be staying in those homes, generating local tax revenues, people and sort of going to restaurants, doing activities in those markets, like to unlock those homes, maybe both figuratively and literally, I could add a lot to the overall global economy.
Yeah, certainly. And not only that, but it disperses travel. There's a lot of these vacant homes are in, cities and smaller cities and rural areas that lack some economic vibrancy. And this is a way to resuscitate tourism and travel into a lot of places, and to connect people, to allow people to go into these areas where there really aren't many hotels. And Airbnb has put out some research on this recently about travel being dispersed into these communities. And a lot of it isn't, that there's a bunch of housing that gets taken off. It's just there was housing that was empty, getting underutilized, or spare rooms or spare mother in law units, for example, that is attracting a lot of people to travel there. And this is something that's really supporting a lot of smaller economies now that it's being dispersed. And this is a significant thing that happened during the pandemic, when it was harder to travel across borders, and also people were road tripping and being able to work remote. this sort of an unintended consequence for the better was that it encouraged a lot of people to take travel into these smaller communities and rent out some of the spare housing. So it's great that it's finally getting put to use. And in fact, it's almost certainly encouraging some additional housing development that's happening in these areas as well. So there's sort of a knock-on spillover effect on the part of that as well.
Correct me if I'm wrong. You add more reasons why a developer should develop. That's not a bad thing for our housing market, which seems to be consistently undersupplied.
Yeah, that's certainly right.
And now I know this isn't going to be a fair question, but I'm going to ask it to you anyway, because I get it asked constantly. And now that there's another economist in the space, where is the best place to invest in short-term rentals today?
It's a good question. I'm excited to dig into that further because I really don't know about the trajectory as to where it is. What I can say is that it's a very uncertain market right now. Again, we're kind of waiting for the other shoe to drop with inflation and what the Fed is going to do with dropping rates. That's going to have a significant impact in terms of, the health of local housing markets. There's an election, there's a war going on that has uncertain effects. There's a lot of moving pieces that could change that equation for people. That said, there was a pandemic boom in a lot of places that sent value up and sent demand up for a lot of short-term rentals. It would have been great to invest before that boom. But now there's been sort of a pandemic bust in some of those places that as demand has pulled back, things are returning back to normal. So, maybe compared to 2019, things are still pretty strong, but compared to the peak, they've fallen a little bit in places like Austin or Phoenix, for example. But that doesn't necessarily mean that they're a bad place to invest now. Maybe prices have fallen enough. I think Zillow just put out in their home value update that home values are down 10% in Austin, 9% in New Orleans, 4% in Phoenix and Vegas. These are places that, could still be profitable to invest in if prices have adjusted enough. The question is, are they going to continue falling or not? That I can't speak to right now. But I do think that the market overall is healthy. It's just, finding the right deal, finding the places where, things are stable enough.
Great job. Those are common themes we've been talking about on the podcast. So instead of sort of housing affordability, we talk a lot about housing or short-term rental investability with a lot of the same metrics. So interest rates are key factors there, home values, but instead of household incomes, it's rental income. And you mentioned we have been seeing a decline in rental incomes. We haven't yet seen a major decline nationally in housing values. We're seeing higher interest rates. I'm afraid now every day to look at what the 30-year fixed rate has reached. And each of those sort of has different aspects to it. And I fully expect a year from now, we're going to be talking about how short-term rental revenues are beginning to increase again, as opposed to sort of the slight declines that we've been seeing, and in some markets more than others. And Austin, Gatlinburg, have been seeing bigger declines given the supply increases in other markets. And we are continuing to see revenue increases at a property level. So I know we already talked a little bit about mortgage rates and where they're going, but given the recent sort of run up in the 10-year and given the spreads seem to still be really elevated, do you have any sort of clarity or at least any expectations on where we could expect sort of mortgage interest rates going forward, or is it too uncertain to really say?
Well, it is uncertain, but I can share what the consensus is. So Freddie Mac, Fannie Mae, NAR, MBA, they all put out housing forecasts for prices, sales, mortgage interest rates. I recommend tracking those if you're trying to get a gauge of what's the expected general direction. You're right that the 10-year has risen. Part of that is just driven by inflation. So once we get more solid cooling of inflation, the effect that we expect to see from the higher interest rates from the Fed, that will inevitably happen. We do see rents cooling, and that's going to continue to pull inflation down in the right direction. So that could really result in the 10-year moderating a little bit. Now, how much is hard to say. But the second factor is, and I'm glad you mentioned it, it's the spread. The spread of the 30-year fixed mortgage rate over the 10-year treasury is extremely elevated. On average was about 1.5%. So if the 10-year was at 3%, you would get about a 4.5% mortgage rate. And that spread jumped to more than 3%. So now the same, 3% 10-year means a 6% mortgage rate. And that spread increased for a number of factors that I don't need to get into now, but some of those factors should ease as we get a handle on inflation, as the economic growth cools a little bit and things are more stable. So there should be some relief. That's the theory as to why we would expect mortgage rates to not continue to climb or just to stay elevated, but over the next year to 2 years, really start to come down by at least a percentage point. That said, just how quickly does this happen? I think everyone would have expected, at least the consensus among the major housing forecasts out there a year ago was that we would have experienced some moderation in mortgage interest rates by now. So the fact that instead it went the other direction and shot up further is really the uncertainty that we're talking about. That it's really hard to predict right now because inflation is just proven to be stubborn, and that's why the Fed is committed to keeping interest rates high until they see significant progress.
Yeah, I can tell you, I was following the outlook. I was ready to pull the trigger, or at least thinking about it on my next sort of investment property, and I was like, oh, maybe we'll see some easing in the rate, and then it's just continued to go the opposite direction. It's been one of those things. Like, I wish we had better clarity now, but like you said, like even just a return and normalization of the spreads could take a 7.5 to a 6, and then and some good inflation prints over the next couple months could pull the 10-year from a 4.7 to a 4.0 or a 3.5. Like we could see some easing pretty quickly with some decent economic figures coming out from the government.
Yeah, certainly.
And sort of last topic I wanted to dig in with you on, and we mentioned it a little bit at the beginning, was I talk about as the midterm rental sector. It seems historically there's been sort of the short-term rental, sort of less than 30 days. There's been long-term rentals, like a year longer lease. And now there's been sort of a blurring and sort of a race to see who can own this midterm rental space, right? So now I think about it as like furnished rentals between 30 days to, let's say, 6 months or so. And one, as a housing economist, do you actually think this is going to be a growing piece of the rental market? Or do you think it's sort of peaked out during the pandemic? It's probably the question I get asked most about, is like wanting data on midterm rentals, wanting data on supply, on the demand side, where people are renting them. What are the reasons why they're renting them? Where should they invest in midterm rentals? And it seems to be coming from both sides. It's like people that have traditionally listed on Zillow or Furnish Finder, some of these other sort of rental markets, and then like coming from the Airbnb side. And so there's a fifth of rentals and over the past couple of years. So one, and do you think it's going to grow? And then two, who do you think is going to sort of own this space long term?
Yeah, that's a great question. I think it certainly will grow in totality, especially globally. There's certain regulations that encourage midterm rentals. There's also growth of mobility that will encourage this flexible space. And then there's remote work. Of course, it was temporarily elevated during the pandemic, but long term, remote work does enable more people to be able to spend a month. So if you're in a hybrid work environment, which I think is the most common situation right now, where you commute into an office 3 days a week, work remote 2 days a week, you're set up as a remote worker. So one of the things that the pandemic did was it set up millions of workers for the first time as a remote worker. They can do their job from home. They can do school from home. They can do different things remotely. And even if that's not the pattern of the everyday life, more people take extended weekends now than they did during the pandemic. So when they're traveling, they might tack on a couple extra days. So business and leisure travel. And that just validifies the point that people are more flexible than they were before the pandemic, even if they're not working remote full time from home or from anywhere. But that flexibility is important because they have the ability now to, work for a month in a place, maybe be with family, or anytime there's maybe health issues in the family, you can go now and rent a home for a month and be with an older member of your family and have that flexibility. Or you're moving to a new city, and now it's easier than ever to find a 1 month rental to make that transition go smoothly. And so that's partly, there's some significant shifts during the pandemic that do encourage the growth of that segment. There are costs and there's things to figure out for both landlords and others. On the rental market side, one of the forces that's also at play is that more and more leases are sort of automatically figured out to what's their optimal duration to encourage people to sign a new lease in the month of May, for example, when rents are going to be highest. And that force really changes the dynamic of even lease lengths in the rental market. So, obviously 12 months is the most common, but there are these little nudges that get people to sign a lease for 9 months or 10 months or 14 months. And even the rental market recognizes that there's flexibility in leases, and some people might need some time when their lease ends to find a place to buy or to rent. So even within the same city, people still have this sort of middle ground. It's not all traveling or working from some island. And so there's all these sort of long-term factors at play. Then there's demographic long-term trends there, where Gen Z, as they are in the workforce now, they're a really mobile generation, and they're really friendly to this idea of flexibility as well. And same with renting cars through Zipcar and all of these other means of being more flexible through the sharing economy, especially. That is also taking place. And so, yeah, I think that flexibility is here to stay. Now, how quickly it grows is hard to say. I think the economics need to be figured out with it. If it can come down in price to a very reasonable amount, then I think more people might take advantage of that. If they were going to spend 3 weeks in a place traveling, they might consider just booking a month and having it be a more long-term, medium-term stay at the same time.
Yeah, so I've loved my conversations over the years with Jesse Stein at Airbnb, the global head of real estate, sort of talking about just working with the multifamily owners on like helping them change how they think about their real estate and sort of maximizing overall profitability by working in short-term and mid-term rentals into that sort of vision for the property. And it can start with the owners, it can start with the guests, it can and start so many different places. But it seems like at Airbnb, you guys are doing a lot of innovation there to help build this market.
And the tenants as well. And I think that's a key growth area at the same time. Is with rents being so elevated, a lot of renters really struggle to make their or to make their rental payment. And this is one of the ways that can also help them. Sometimes renters need to go and leave a space early or vacate it for a month, and more apartments being able to rent out their home for sublet it for a month or short-term rental at the same time is also key growth for that. So more renters being able to take advantage of that. There's even products now for renters designed to allow them to, rent an apartment for 3 months in one city, be able to go to another city for another 3 months. And that's, sort of just innovations in the rental market that's also continuing to happen.
Well, Taylor, and we can leave it on that note. Thank you so much for joining. Can you let our listeners know where to find you and where to find the research that you're going to be putting out?
Yeah, so right now, the easiest way to find me and to follow my work is on Twitter. I'm at Taylor A. Marr. And, as I get to ramp up and produce more housing research, that will go on Airbnb's blog at news.airbnb.com. And we're going to hopefully find a way to find a special place for this housing data enriched research and be looking out for that as well.
Awesome. Well, again, Taylor, thanks so much for joining, and thanks listeners for joining in.